Hey everybody, this is Robert Scott, Chartered Financial Consultant in Brentwood, Tennessee. On this 3-slide video, we're going to answer the question, is term insurance really cheaper? Hope you enjoy the show. All right, so let's take a look at this slide here. It's a year-by-year comparison. Now we're illustrating a 20-year level term at age 25, a 20-year level term at age 46, and a 15-year level term at age 65. Many of you might not know you can't buy a 20-year level term at age 65 from most insurance companies because the risk is too high that they will pay a claim for what would be considered a very low amount of premiums. Even over your lifetime, if you died at age 85, the insurance company would have collected $382,000 of premium and paid you $1 million. It's still not a bad trade. But if you let compound interest work for you, which is exactly what happens inside of a cash value policy, look at what happens over here in the cash value premium side. Now, as you can see, those premiums we illustrate are flexible. So you could put in $3,500, $3,000, $4,500, $4,600. It doesn't matter how you get the money in, but this is illustrated with overfunding, meaning you're putting in more than the minimum cost of insurance. What happens is that excess money goes into a side fund earning interest based on the performance of an external stock market index, such as the S&P 500 or the NASDAQ or any number of other indexes available. As you can see, looking at age 46, if you just decided to walk away from this policy, there's $91,000 of cash value sitting there. So if you cash this policy in, you'd lose your insurance coverage, which probably isn't wise, and you would pay taxes on the gain if there was more cash value than premiums paid in. At 65, though, most people think about retiring. Wouldn't it be nice not to have to pay any insurance premiums from 60 on? So by overfunding this policy, we created a scenario where this account really just continues to grow anytime there's an interest credit in excess of the cost of insurance and the expenses. Now, a beautiful thing happens right here in this last circle at age 80. You notice we have section 7702. The IRS code says when your cash value is close enough to the death benefit, they have to raise the death benefit. The difference between those two numbers, it's the life insurance part. That's what the insurance company pays to your beneficiaries. But if you choose not to cash it in again, pay the taxes, over in this far column, we'll show you that if you don't need that insurance, simply start taking a cash loan, in this case of $52,000 that would run to age 95. That is a tax-free income that you can use to supplement your Social Security, your pension, your 401ks if you've had a chance to save them or not. For those of you who buy term and invest the difference, I challenge you to show me how much you've had a chance to save in your investing the difference side account. This puts it on automatic, and as I've learned over the last 28 years, automatic is the best way to ensure that you will have something to show for your years of work when you retire. So for those of you who would like to see it in a little bit of a picture, we're going to look over here at the next slide. So finally, here is a picture just to show you the difference. Now note the green line are the cash value insurance premiums. The blue line is the term insurance premiums. This does not account for any cash value or any money you might get back if you terminate your policy because your side fund ended up having more money in it than you actually paid into the contract. This generally takes about 20 years or longer, but it can be higher depending on how much you overfund your policy from the beginning. So as you can see, at age 60, when you should be enjoying life and retirement and grandkids and travel and everything else, you can see that having an enormously high expense for term insurance is not really the best financial planning, if you ask me. And now that you know, you probably would agree, it doesn't look as good as having a bunch of money sitting there that's tax-free when you pull it out if you play by the rules, or just pay taxes on the gains if you choose to not need the insurance anymore at that point. So we hope this has been a little bit of an enlightening video for you to watch. I hope it's been educational and taught you some things that no one else has. We appreciate your time and checking us out. If you'd like us to review your insurance plan, call us or visit us online at lifeinsurancelc.com. We wish you the best. Have a great day.